But come tomorrow, and it's going to be officially kickstarting the earnings season. Let's bring on board Suhas Harinarayanan, who is joining in from JM Financial to talk about the expectations from the Q2 earnings. Good to have you on board. To begin with, let's just talk about the overall universe. What kind of revenue as well as profit growth are you expecting from India Inc.?
So we cover around 200 companies for the, for 80% of the companies that we cover. We are expecting a flat revenue, probably even a flattish EBITDA. The PAT growth obviously is going to look slightly better on account of one, the very low basis that the some of the financial companies had last year, as well as due to the benefit of the tax cuts. We are hoping that some of the consumer companies and companies in pharma, etc., will certainly benefit out of this. So clearly, the profit growth could be around 5%, but as I said, I think it also depends on how the companies finally move to the new tax regime. So it's not all festive season for the earnings counter, at least, because even if you look at the Nifty earnings is expected to grow by probably mid-single digits. So after a first quarter number of which was also close to 4%, so you're going to see another quarter of probably mid-single digit kind of profit growth. So that's the broad, expectations. In terms of sectors where we expect strong growth, clearly consumers stand out, financial stand out. I'm talking about profit growth, not necessarily revenue growth. But yeah, consumers, pharma, financials clearly stand out as sectors that will contribute, to the growth on the profit side. While auto and auto ancillaries, obviously sectors that are going through, massive slowdown at this point in time, as well as telecom and metals will probably bring up the, the back of the pack in terms of earnings growth.
So that's the auto pack. On margins as well, you have seen that you have said that you expect to see contraction there, excluding financials. Where do you feel we'll see the worst hit when it comes to margins as well, Suhas?
No, as we have indicated, I think wherever you'll have operating deleverage, which is primarily I think auto angs, clearly the numbers are going to look bad. I think the overall numbers in terms of profit growth, we are looking at about a 66% decline in on a YOY basis for for the auto and entire auto and auto pack, auto ancillaries as well. Similarly, for metals, there's a similar decline of about 66 to 67% on the profit growth. So I think these two are the sectors where we expect the maximum decline in profits. Telecoms, on an overall basis, the comparison actually becomes a little difficult because lots of companies have losses and losses moving to staying as losses, right? So really, there's no comparable YOY number we can put there. We can, as we're aggregating for all the companies, we can come with a consolidated profit number. But I think in terms of where the maximum declines are expected are in autos and metal sector.
Suhas, in this quarter gone by, while yes, the demand slowdown has been a large issue, so have NPAs. What is it that you're expecting from the larger financial basket? And that's both banks as well as NBFCs. What are we likely to hear from the reportage of this entire segment of the market?
I think, as you highlighted, I think clearly the credit cost numbers would be higher for at least the PSU banks and maybe for very few select banks as well. Most of them are guided for a certain amount of credit costs. In a few cases, it's likely to be higher than that. Comparing on them on a YOY basis, probably we'll still get an extremely high growth. If they especially decide to postpone the moving to the new tax regime, etc. Because the point is, last year some of these banks actually had even higher credit costs. Right, so YOY basis, you could actually show you could actually end up seeing very strong numbers. But on as you mentioned, given the slowdown, we are expecting some of the public sector companies and certain other banks, as well as to show higher credit costs than what they probably guided for.
Okay, so let's talk about where we do expect to see growth then. You have mentioned financials, perhaps even healthcare staples. Talk to us, again, within that, perhaps, what are some of the trends that you see emerging, where you possibly see, attractive opportunities, with regards to seeing good earnings coming in and, boosting sentiment there. Where's the growth potentials as?
So I think for this quarter as well, given that this obviously pertains to the slowdown quarter, I don't think we are expecting a revenue growth number which will be a surprise. Profit growth will be in line with I think to the extent of tax cuts that some of the consumer companies will probably take benefit of. What will be interesting to watch out for will be the commentary regarding where they expect in terms of how the recovery is happening on the ground. The one segment where we actually expect some form of I think cautious optimism is possibly on sectors related to agri consumption. We recently completed our comprehensive rural survey, and what we see is that the agri income part, given that the prices aren't worse off compared to last year, in fact in a few cases it's higher than last year, and the fact that your reservoir levels are high, and so the expectations are for a very strong Rabi season as well. So products or objects that are primarily used from an agri standpoint, I think, like for example tractors, you could actually hear a little bit more positive commentary than for some of the other discretionary items, right? So I think the agri side is where we expect a little bit more optimism coming through than in the other sectors.
All right, thanks much for joining in and giving us an all-round view as to what the earnings expectation is. So in consensus, with the street view that it's going to be a fairly tempered quarter before we actually see a recovery, and that may kick in only by the time it's Q3.